Alrighty. So in today's video, I'm going to be talking about how to sell put spreads, also known as the bull put spread, for consistent income as a beginner. So if you're new to trading options, or maybe you've been trading for less than a year, then I'm going to share with you a very simple way to trade this bull put spread. So first of all, what exactly is the bull put spread? So the bull put spread is generally a neutral to bullish strategy. And by that, I mean that in order for you to be profitable on the trade, the underlying needs to either go up, and this is the fastest way for you to be profitable, or it can even go sideways as well, right? If it goes sideways, you can still profit on the bull put spread. And even at times, if the market comes down, as long as it doesn't go down too much, you can still be profitable on the bull put spread. And I'm going to share with you how that works later on. Now, next, how do you exactly construct a bull put spread? So the bull put spread is actually very beginner friendly because there's only two legs to it. And by two legs, I mean that there are two option combinations to this, right? So the very first one is to sell what's called an out of the money put option. So you will see this term sometime whenever you watch other videos or when you read articles, you see OTM. OTM just means it's out of the money. So how do you tell whether it's out of the money for a put option? So this is something that you need to really understand. So let's just say right now, this is where the current market price is. So there are three sections in general. So you have the section whereby it's somewhere near where the current price is. And then you have the one above where the current price is. And then you have below where the current market price is. Now, for a put option, if you choose the strike price that is above where the current market price is, so somewhere in this region down here, then this is what it's called in the money, right? So that is why you have the initials ITM, in the money. Now, if you would choose the strike prices somewhere around where the current market price is, then that's what's called at the money, or ATM for short. Now, if you were to choose the strike prices that is below where the current market price is, then this whole region down here is what's called out of the money. And when you're trading the bull put spread, you want to select the strike prices that are out of the money, right? So you start off by selling an out of the money put option, and then you buy a further out of the money put option down here. And the purpose of this further out of the money put option is so that you cap your max risk, right? Because there could be times whereby the market will just go all the way down, right? It could even crash. But you do not have to worry if you have this long put in place, because this long put really just caps the max risk. So whatever you risk for the trade, you cannot lose more than that, even if the market really goes past your whole put spread. So this is a very important part of constructing your bull put spread. Now, how do you make money on the bull put spread? So when you sell the bull put spread, you receive what's called a credit, right? This is also what's known as premium. So sometimes when you hear other people talk about, I receive this amount of credit, I receive amount of premium, or I'm doing premium selling strategies, what it just means is that they receive some money upfront for putting on the trade, right? So this is how these credit strategies work, like bull put spread. You receive amount of money upfront, and this is already deposited into your account. And then from there, you put on the trade, you trade it. Okay, so as you can see down here, the credit very simply is whatever is shown on your trading platform, right? So on your trading platform, so for this is Tasty Trade. So whatever platform you're using, it should tell you what is the credit that you're getting. So if you see a credit that's $1.14, it just means that you're receiving a amount of $114 per bull put spread, because each bull put spread or each option contract actually controls 100 shares. Right? So this credit that you receive is also the max profit on the trade, right? As you can see down here, this column, or rather this box in green, shows your max profit is $114, which is the same as the credit which you receive. So when you put on the bull put spread, whatever you receive upfront, that is the most that you can make. Now, that is not to say that you will keep everything of it. It really depends on how you put on the trade, how you manage it. And I'll talk about it a little bit more later on. Now, to be profitable on the trade, you need to close out the trade for lesser than what you had sold the bull put spread for. Okay, so for example, if you sold the bull put spread for $1.14, so this is the credit you received, the premium that you got. you need to buy back the bull put spread for less than $1.14. So for example, if you bought it back for 14 cents, that means you gain $1 on the trade. So this equates to $100 per bull put spread. So when you're trading credit strategies, for example, this bull put spread, what you're actually doing is that you're selling at a higher price and you want to buy back at a lower price. Now, what if you bought the bull put spread for higher than what you actually sold it for? So let's say if you bought the bull put spread back for $2.14, in this case, it means you lost $1 on this trade, which equates to $100 per bull put spread. So this is the whole idea of the bull put spread, right? You want to buy back the trade or close the trade for lesser than what you received the credit for. And if you leave it to expiration, what it just means that it becomes zero, right? So if you sold it for $1.14 and then you leave to expiration and it expires out of the money worthless, it just means that the spread becomes $0 and you receive the full premium of this whole bull put spread trade. So now that we've already talked about what's the max profit you can make on the bull put spread, what about the max risk, right? What is the max loss that you can get on the bull put spread? So it's actually also very simple to calculate. So it's basically the width of the spread minus the credit that you receive. So what is the width of the spread? The width of the spread basically is the distance between the strike price that you chose of the short put and the long put, right? So for example, in this example down here, the short put down here would be at the strike price of 555, and then the long put would be at the strike price of 550. So what is the width of this bull put spread? Well, the width is just simply $5, right? You take 555 minus 550. That means to say your max loss is $5 minus whatever credit that you receive. So this credit you receive is $1.14. So as you can see down here, the example, if you sell $5, you receive $1.14, then your max risk is $5 minus $1.14, which is $3.86. That means your max loss is $386 per bull put spread. So again, you can just confirm this in your ticket, your order ticket when you put on the trade. Before you put on the trade, you must always check what is the max loss, what is the max profit you're going to get, and see that you're comfortable with that, right? So as you can see down here, it's $386 in this red box down here. So this confirms that our max loss is this amount. Now, the question you might have down here after seeing the max profit and the max loss is, why is the bull put spread max loss more than the max profit, right? As you can see down here, if you lose $386. But if you win, you only win $114. So the risk reward down here is like you're risking roughly $3 plus just to make $1. So you might be wondering, why is it like that? Well, that's because firstly, it's just the design of a credit style strategy. When you trade a premium selling strategy, what you notice is that you always get the characteristic where the risk is more than the reward. However, it's actually just a trade-off. So while the max profit is lesser than the max loss, it's actually being compensated by a higher probability of profit, also known as the win rate. It just means that you're going to get a higher win rate, which is more than a 50% chance to be profitable, right? So as you can see down here, the pop here, which is the probability of profit, is 66%, right? This is more than a 50% win rate. So for example, if we compare it to just buying the stock outright at the current market price, from a simple probability standpoint, there's a 50-50 chance you're going to make or lose money, right? It's like a coin flip, right? If it goes up, you're going to make money on the trade. If it goes down, you're going to lose money on the trade. Now, if you sold the bull put spread, you will notice you actually have a bigger profit zone, a wider profit zone for you to make money in. So naturally, you would have more than a 50% chance to be profitable because the market can still go up, go sideways, and even go down. You can still make money. So this is what I mean. So as you can see down here, this green box down here is the profit zone of putting on this bull put spread. You can see it's much wider than if you were to go for the outright trading, right? If you just buy the stock outright, only half of it is profitable, the other half is a loss. But for the bull put spread, you have a much wider profit zone. And that is why your risk to reward ratio is not as good, right? You usually risk more to make less. And you notice one thing as well is that if the market actually goes down below your short put, you can actually still be profitable. And why is that so? Why? Because you actually receive the credit for putting on the trade. So when you receive a credit, it actually helps lower the break-even point for the trade. So remember, the max loss of your bull put spread is the width of the spread. So as you can see, this is the width of the spread, which in our example is $5. But then you have to minus off the credit that you receive, right? Minus the credit. So this green box down here, the small little portion where it came down a little bit into the bull put spread, that's because of the offset from the credit. The next question that you probably would have, and a lot of people would have, especially if they're new to trading options, they will say, hey, Davis, wouldn't just one max loss wipe out many of your small gains? By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. And the answer is this. Yes, if you, number one, you construct your bull put spread with a very low delta, right? Some people like to go very, very far out of the money. For example, you can see in this picture down here, this bull put spread is considered out of the money and it's below where the current market price is. But some people want to push this whole spread down here even further out of the money. They want to make it even lower so this profit zone will become even wider. And this is where the problem arises, because if you were to stretch it so far out of the money, then this is where you can have this kind of risk to reward ratio, whereby the max risk is so much bigger than the reward you get. So as you can see down here, your reward is $21, but when you lose, you're going to lose $479. So this is one of the problems where beginners have when they construct it, because they want this very high win rate. As you can see down here, this win rate down here is 95%. You can win a lot, but that doesn't mean that you won't lose money. Remember, every time when you see a pop that has 95% or 90%, what it just means is that there is a 5% or 10% chance that you're going to lose money. And you don't want to think as though, hey, it's 95% chance, right? Most likely I won't lose money. No, that doesn't mean that. If you trade long enough, that 5% loss is going to come. And it also depends how you're going to manage the trade, because if you're going to let this 5% loss become a max loss, then of course you're going to wipe out many of your small gains with one max loss. So the second reason why many people have this problem of having one max loss wiping out many gains is because you let yourself get a max loss, right? There is no reason why you want to get into a max loss, because you can actually reduce the chances of you getting that max loss. And how do you do that? Well, this is why you want to implement proper trade management so you avoid getting the max loss. So for example, if you exit latest at 21 days to expiration, or DTE, then your average loss actually becomes much lesser than if you were to hold all the way to expiration. So many beginners, when they trade this put spread, they always think that they need to hold the trade all the way to expiration. In fact, that is not necessarily the best way to trade the put spread. In many cases, you actually want to get out earlier. And as you can see down here, this study down here is by the Tasty Trade team, whereby they've already studied this put spread very extensively, and they tested it out, right? They tested it out with different exits. So you can see down here, there are 2 different types of exits. The first exit is to hold all the way to expiration. Now, the other exit is to get out early. And by getting out early, it just means that when there's 21 days to expiration left in the option, they just exit the trade, right? For example, if you put on the trade for 45 DTE, so when you look at the option chain, you look at the DTE, it says 45. This is when you first put it on. Now, when a number of days go by, this DTE actually starts to drop because there's lesser and lesser days left to expiration. So once it reaches 21 DTE, that means there's 21 days left to the expiration of the trade, not holding for 21 days, right? A big difference. You're not holding for 21 days, rather you hold the trade until there's 21 days left to the expiration of the trade, then you exit it. So as you can see, based on their study, right, they did 2 different tests between the $5 wide put spread and the $10 wide put spread. And what they found is that if you were to exit the trade much earlier at 21 DTE, your average loss becomes so much more lesser compared to if you were to get out at expiration. You see, if you get out at expiration, the max loss is so much bigger. But if you get out earlier, you actually get lesser loss. Now, that is not to say that you're going to get a worse performance, because again, according to their test, you can see the annual ROC, you actually get a higher return if you were to get out earlier compared to if you were to exit expiration. So if you want to avoid this issue whereby, hey, just one max loss is going to wipe out so many of my game, I don't think this bull put spread is going to work, then all you got to do is to exit earlier. Because when you do that, you'll find that your losses are controlled, your overall performance of the trade is going to become better. So you might be wondering, why is it that, if I exit at 21 DTE, my loss is actually lesser? And here's the reason why. What you see on your P&L graph, right, as you can see down here, this line down here that I've just drawn, this is your P&L at expiration. So how do you see this graph? Basically, the green color portion is where you start to make money. The red portion is where you lose money, but at expiration. So what you can see down here, this dotted line down here is where the current market price is. So if the market actually goes up from where the current market price is, you're in a profit. Now, if it goes down and it goes low enough, you're actually going to be in a loss. But you actually do not hit the max loss until expiration, right? Many people think that, hey, if it goes below into the red zone, you're going to lose this max loss down here. But that is not true, because what you actually lose, it actually comes down to this blue line down here. Do you see this blue line over here? So this blue line down here keeps changing every single day, right? As it gets closer and closer to expiration. So basically, this blue line down here will slowly change and become this line down here at expiration. So this blue line down here is just at 21 days left to expiration. So what you notice is that if the market actually comes down to this point down here, your loss at 21 DTE is actually much lesser, because this is where your actual loss is, compared to if you were to hold to expiration. If you hold to expiration, your loss is here, and this is the $0 mark, right? So anything below here, you start to lose more and more and more, and anything above the zero line, you're going to be in a bigger profit. So you can see that once you get out 21 DTE, regardless where it is on the graph, so for example, if you reach a point, say somewhere around here, then you actually lose lesser, right? So that is why when you cut off at 21 DTE, as this data suggests, you're actually going to have a much smaller average loss. So if you're afraid that one max loss is going to wipe out your trade, just exit at 21 DTE. Now, the next question you might be asking, Davis, what if I wanted a strategy that has a higher risk reward ratio? For example, I want a strategy that gives me, a risk reward of 1:3, right? Risk $1 to make $3. Then the answer to this is that if you want to, then you cannot trade premium selling strategies, but instead you want to trade premium buying strategies, because all premium selling strategies basically have this characteristic whereby you're going to risk more than what you make. And the trade-off is that you're going to have a higher win rate. But if you insist on getting a better risk to reward ratio where you actually get more reward than you're risking, then in this case, you might want to go for premium buying strategies. So as you can see, I've constructed one down here, which is a debit spread. This is the call debit spread, also what's known as the bull call spread. So straight away, you can see down here, your risk to reward ratio is much better than a 1:1, right? You're risking $148 to make $352. So this is roughly, you risk $1 to make roughly $2.20 or 30 cents or so. So this is the kind of strategies you want to go for if you want to go for a higher risk to reward ratio. However, very important, there is a trade-off. What is the trade-off with getting a good risk to reward ratio? The trade-off is that your win rate, right, your probability of profit is actually so much lower. As you can see down here, this is 30% compared to previously where I show you the bull put spread structure, that is about 66%. Right? It's more than 2 times the win rate. So you can see straight away this is a trade-off, and there is one big problem to trade this strategy as a beginner. And this is something that many people don't understand, and that is the psychological part. If you were to trade this strategy with a low win rate, what you will find is that over time, you will find it very difficult for you to continue putting on this strategy. Now, that is not to say that, the debit strategy is not profitable. It can be profitable. It's just that the journey for you to have a consistent profit or to see the upside over a long term can be quite difficult because of one problem. And the big problem is the potential losing streak, right? So the problem with low win rate is that you have to sit through all this long losing streak and still be able to stick with the strategy. So for example, if you were to take a look at this 30% win rate, so this table down here basically is the probability of X consecutive losing trades within a 100 trade sequence. That means to say how many losing trades you have in a row when you trade total about 100 trades. As you can see in this table down here at the top, it shows the number of consecutive losses, this number down here, and this table shows the win rate. So 5 down here just means there are 5 consecutive losses in a row. That means you lose, you lose, you lose, you lose, you lose, 5 in a row. And you can see for a 30% win rate strategy, there is a guaranteed chance that you can have 8 losses in a row when you put on at least 100 trades or more. Now, how many of you are able to sit through 8 losing streaks? I've spoken to a number of people, and recently I spoke to someone, right? He told me that as long as he has 2 losses in a row, he's going to stop the strategy, he stopped trading it, right? So as you can see, if you were to trade this call debit spread, straight away, after 2 losses, if you're going to quit, you're never going to see the upside of the strategy, even though it's going to be profitable in the long term. So you can see down here, there is even a 93% of 10 losses in a row. That means sooner or later, you trade long enough, you will reach a point whereby there's 10 losses in a row. Now, on the other hand, if you go for maybe a 70% win rate strategy, the number of consecutive losing trades you're going to have is much lesser, right? As you can see down here, it's only a guaranteed 2 losses in a row out of 100 trades that you put on. And you can have up to 55%, pretty much a coin flip when it comes to 4 losses in a row. And you can see it just dramatically falls off the probability, the number of losses. That means the chances of you actually getting 5 losses in a row, 6 losses in a row, and so on is getting lesser and lesser. So when you compare these 2 strategies, which one do you think is easier for you to put on the trade, especially if you're new to trading, right? Many beginners new to trading, they just want to see wins, right? Even I spoke to a person recently. He has put on this high win rate strategy, which is about 80-something%. But just 1 loss has really shook him up. He has 1 loss and he stopped trading the strategy because they just cannot accept the loss. So that is why you need to understand the difference between a debit strategy and a credit strategy. Now next, I want to compare the bull put spread against the short put. So why the bull put spread instead of short put? So if you have been watching a number of YouTube videos, you've seen a lot of people talk about, hey, sell the short put for passive income, sell the short put for consistent profits, right? And I've also created a few videos on that as well. But why do I suggest the bull put spread instead of the short put for beginners? Well, the reason is because number one, the short put requires a much bigger capital. So in options term, we use the word buying power requirement, right? So you will hear this quite often. So basically, it's just the money you have to put up to the broker to place the trade. And that is why with a short put, you notice the buying power requirement is actually much bigger. You can see down here, the buying power effect for a short put is $10,000 over dollars. And if you were to see the max loss, it's $54,000 because this is what's called an undefined risk strategy, whereby there's no protection to the downside. If the market keeps going all the way down, crashes immediately like a flash crash, you're going to lose a lot of money. So if the underlying crashes, you can lose more than the capital you put up for the trade. So as you can see, you put up $10,000 plus for the trade, you can potentially lose more than that. Now, on the other hand, the bull put spread requires a much smaller capital and caps the max risk even if the market goes to zero, right? You cannot lose more than what you put up for the capital. So as you can see down here, the buying power effect or the capital you put up for the trade is $386. What is the max loss? The max loss is the same, it's $386. That means to say, even if the market crashes all the way to zero, you still do not have to worry because you cannot lose more than what you put up for the trade. So that is why for beginners, I really only suggest for you to put on the bull put spread. unless you do not mind getting assigned the shares of the underlying. So the only time that I would suggest to trade the short put is if you plan to actually go long the shares of the underlying. Maybe you want to collect the stocks, maybe it is that you're trading the wheel strategy, then yes, you can go for the short put. But if you're planning to just trade the options, that means you want to get in and get out of the options, you do not want to get into shares, then the bull put spread will be a better strategy for you. So finally, how do you trade the bull put spread? So if you're a beginner, you're new to trading options, then I'm going to share with you a very simple way to trade the bull put spread. Now, this is not the only way to trade it, but I suggest this as a way to trade it because it's going to be simple and it's going to put the odds in your favor. So there are a few steps for this. So the very first step, first of all, just find stocks that are in an uptrend. What do you mean by uptrend? Well, uptrend, basically, you can see that this wave pattern where it's forming all these higher highs and higher lows. That means you know that the market has a momentum that is going up. Now, the second step is to add the indicator called the stochastic oscillator. Right? The stochastic oscillator, basically what it does is it measures overbought and oversold conditions in the market. Overbought just means that the market has gone up quite a bit and it seems exhausted. And oversold just means the opposite, right? The market has gone down for quite a bit and it seems exhausted. So anything that is above this red line at the top, so as you can see down here, this is what you call overbought. And then anything that's below the red line at the bottom is what's called the oversold condition. So what we are really looking out for is the oversold condition as opposed to overbought or somewhere in the middle. So why is that so? Right? So if the market is going up and then you find it at the overbought point, yes, it may go down, but you notice the waves down, the movement down is much smaller than the moves upwards, because generally this is trending upwards. So that is why we want to only find when it's oversold. So if you find oversold in an uptrending stock, like for example down here, then there is a higher probability that we know that the market can go up compared to it to go down. Right now, of course, there's always a chance the market can continue to go lower, you lose on the trade. That is part and parcel of trading, right? If you have a 70% win rate strategy, it just means that you have a 30% losing rate on the strategy. So expect the losses to come, right? Do not just put on one trade or 10 trade and say that, hey, Davis, I'm still in a loss, right? Because there is always a chance that you could still lose. And for the past 10 trades, overall could still be a loss. Aim for the next 100 trades, okay? Now, next, identify support levels. So you can see down here, I've drawn a line over here. And this line just basically is a place whereby there were previous bounces off this area, right? So when you see the price bounced off certain areas, like for example here, then this is areas where we can draw a line and we call this support levels. Because the next time the price comes down, then there can at least be a better probability that the price could again bounce back up than it to go down. Now, step number 4, sell the bull put spread below this support level. Right, so we know this is a price level whereby there is a possibility for the price to bounce up. So that is why we want to put our bull put spread below it. Now, how far below this really comes down to you. Again, you got to adjust this based on your risk to reward ratio and also, based on the support levels. So you can see down here, if you see that there's another support level below, you could choose to place one even further out of the money. Now, what about the DTE? Now, the DTE is what I would suggest. Just choose the closest to 45 DTE. And the reason for this is because the Tasty Trade team have already did the study. As you can see down here, the table down here, the study was to measure the expected move versus the realized move. Now, I've already created a whole video just on this, right? On the expected move versus the realized move on my channel. It's called the #1 secret to becoming consistently profitable. Just go ahead and watch that video if you haven't. But for this video, what you just need to know is that our edge comes from the fact that the realized move is actually lesser than the expected move. The expected move is basically what the model predicts, the movement of the underlying. The realized move basically is the actual movement when it actually already happened. So our edge lies in this whole fact down here. However, this fact down here, or rather this edge, can only be found when you trade the 45 DTEs and above, right? You can see down here, anything that is lesser than 45 DTE, you can see down here, it says expected bigger than realized. The answer is no. That means to say the movement is about equal. But if you want an edge, go for the one that is closest to 45 DTE. Now, step number 5, the final one is trade management. So how do you manage the trade? So if the trade is in a profit, there are two ways to exit. Either exit at expiration or at 21 DTE. And you can actually leave to expiration if you want to, because the market did not come low enough into your bull put spread, so you don't have to worry about being assigned early. That means you could be assigned on this short put down here, and then you're going to get 100 shares, right? But you don't have to worry about this if the market has gone up, because the trade is in a profit. So you can either exit at expiration, or you could choose to exit earlier at 21 DTE. And again, I've already shown you the statistics to show that if you just exit at 21 DTE mechanically, you're going to get a better return over time. Now, there's another one, which is to just exit at 50% take profit. Now, you can do that as well, right? I mentioned this in quite a number of other videos where you can combine 21 DTE and 50% take profit. But for this video, I want to keep things very simple for you, just to two management style, right? Either at expiration or at 21 DTE is smaller enough for you to still be profitable over the long term. Now, what if your trade is in a loss? If your trade is in a loss, then simply exit if there's less than 21 DTE. But if there's more than 21 DTE, you can just simply hold on to trade. So for example, if the market comes down here below your put spread and you notice that there's still 30 DTEs left. Now, in this case, all you got to do is just hold on to the trade, because you never know. Before 21 DTE, the market might just bounce back up again, and then you would be in a profit in this case. But if it's less than 21 DTE, we want to exit because of two things. Number one, we want to prevent the loss from potentially getting bigger. Number two, we want to prevent the possibility of early assignment risk. So as you can see down here, this is an actual trade example that I put on the bull put spread on, as well as a few other strategies. But you can see down here, the moment the market came down, it broke through this support momentarily, and then it bounced back up. So that is why it's very important to find these support levels, these support areas, because you want to find certain places where the market can bounce up. At the same time, it's already oversold. So there will be a point in time whereby the movement downwards will be a little bit exhausted, and then there could be a move back up. And when it moves back up, then this is where you want to manage it according to what I mentioned over here. All right, so this is a simple way for you to trade the bull put spread. So let me know what you think in the comments below. By the way, if you like this video, then you're absolutely going to love this next video which I have for you. So go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen, and you'll be able to get it for free. All right, I will see you in the next video.